Hey guys, the big news this week is the credit crunch tsunami launched by last month's bank panics is now hitting land, with buildings collapsing in car loans, housing, and business loans. The recession signals are turning into sirens. The latest news is that banks are cutting off loans and credit to car dealerships. Capital One, one of the biggest car lenders, is even pulling their floor plans that dealers use to buy cars to populate their lots. Now, the reason banks are pulling out is that it's super hard to get buyers approved since banks are pulling in lending overall. So banks aren't worried whether the dealer can sell the car, it's whether the bank wants the car buyer as a risk. Now, it's worth noting that consumers' credit scores are holding up just fine. The average is steady at 787. So it's not the car buyers, it's the banks. Now, if this keeps up, dealers start losing a lot of money on the cars sitting on their lot. They eventually run out of money and have to raise fast cash selling the cars at auction. This craters car prices, but it also wipes out dealers. In fact, just a few days ago, a big used car dealer group, USA Auto Sales, just announced it's indefinitely closing 39 dealerships. Now, as big as cars are, there are about 1.4 trillion in car loans outstanding. Mortgages are in even worse shape, and there's almost 20 trillion in mortgage debt. Now, remember, mortgages is what set off the last big crash we had in 2008, the one they said would never happen again. So what's happening in mortgages is applications have plunged while households are struggling to stay above water with debt to income ratios. That's how much debt versus how much you make. Those are now higher than the peak before the 2008 subprime meltdown. This is driving defaults. So FHA mortgages, those go to first-time home buyers, and typically with 3 to 5% down, so they're fairly risky. Those are now hitting 12% in the most recent numbers. As for mortgage applications, those are close to the worst of 2008. Now, the problem here is homeowners are sitting on low-rate mortgages, so on average 3 or 3.5%, but new mortgages are closer to 7%. So the owners don't want to sell. They'd have to trade a 3% loan for a 7% loan, which means paying about $1,600 more per month on the median house. Of course, buyers aren't all that excited either. So between near 7% loans and soaring house prices during the COVID era zero interest rates, they're looking at a $2,700 mortgage payment. That's up from $1,800 2 years ago. Finally, the one that really bites, business loans. These keep the jobs alive, and the jobs are holding up all those cars and houses in the first place. So since the bank panics hit last month, banks have dropped credit by about $270 billion. About a quarter of that, $65 billion, was in commercial and industrial loans. So you're seeing pullbacks in small business loans, real estate loans, even construction loans. The only bright spot is credit cards, which pay so high, banks will eat those all day long, and which are, therefore, a classic distress signal that families are in trouble. Beyond the job losses, the concern here is that tighter business loans mean the businesses have to start using up their cash. That pulls cash out of the banks, which, thanks to fractional reserve, ripples into yet more credit tightening. You can even get this feedback loop with tighter lending leading to yet tighter lending, while companies drop like flies, taking the jobs down with them. We're already seeing this play out with small business bankruptcies at a record high, manufacturing at a 3-year low, despite the recession not even officially having started yet. So there's a good chance that we're looking at a lot more pain to come. All right, we'll be watching. See you next time.